All right, good morning, realtors. It's already October 8th. We're on full gear of the last quarter of 2024. We have 3 more months left, guys, to really just hit our production goals, to focus on getting a few more sales while the business still seems to be reinvigorated. And what do I mean by reinvigorated? There's more what's called optimism regarding our economy, that we're not going to have a crash or a recession. Yes, we are approaching an election year, so who knows what happens depending on which way our country goes and decides on our whether we're, what side the political spectrum that's going to be in office next year. But regardless of which, the Fed is telling us a few things, and they're trying to hold inflation in check. And the most recent 2 weeks ago, they did a half point federal funds target rate reduction. And so now that's having some nice positive reinvigorated momentum for the buyers who were kind of on the borderline fence of purchasing a property. This really helps those buyers that are kind of still borderline determining whether or not they want to enter right back into the market after getting frustration or just scared off because the rates were 7% plus in the whole past year or two. So therefore, I think it's good to kind of circle into the market update. And that's something I wanted to cover in today's topic, is going over the CAR housing forecast slides produced by Jordan Levine. And hopefully you can see my screen. This is probably going to be better if I download it. So let me close this and I'm going to open up a downloaded version. And by all means, if any of you have any questions or things going on in your transactions or specifics you want me to cover, you're more than welcome to always stop me and let me know. Okay. So here we have the full screen of the forecast slides, and I'm going to cover the hot topics that are very newsworthy, presentable to your clients, great for your gatherings or Halloween parties, or really just whenever your client asks you, "Hey, Kelvin, what's going on with the market? How's the market doing?" You have some prepared response to share with facts and data. So what are we seeing? Well, the market's not crashing. The housing market is definitely still rising, and the home prices are appreciating still. And the median California properties, I read somewhere it was around, I don't even want to say, but it was close to $900,000 was the median home sale price. So that's something interesting. So we see our economy really continuing to expand. There are some companies still having what's called a good job creation report recently. So there's not a lot of what's called unemployment going on. And the home ownership is still a valuable and desirable thing. That has not changed whatsoever. These are the forces driving housing activity. But what's making it weak in today's market? Well, it's homeownership and affordability. It's really shrinking. There is a lot more tenants than there were just a few years ago. There's a lot more renters in California because it's unaffordable. It kind of takes two household incomes in order to be able to afford one monthly mortgage payment and qualify for an 80% financing conventional loan. Excuse me. So there are a lot of people who are still doing a lot of remote work or working from home. There's a lot of population that's really just not does not want to go into the office. They're still doing more independent work or home office work slash, just maybe just in more of a independent type of mindset as opposed to many years ago where every employees, they stay at their company for a long time. That's not a lot of the new young generation nowadays. So the rates do expect to remain relatively elevated because the mortgage rates are not directly tied to what you call the federal funds target. There's a correlation, a strong relationship, but not necessarily one to one. So what we're going to see the challenges for us realtors and the forces against housing. It's still not completely ruled out that there's a recession. There's always the possibility that something really major or a really bad stock market, or maybe there's a lot of a bad, unfavorable legislation causes some more recession or jobs to be unemployed and cut different businesses. The housing supply in California still remains very limited. I read another recent report that tells me that the number of new build construction starts are not building a lot of housing in California as to what the quota requirement that we should be doing. So most people who are doing housing starts and construction permits are actually just doing it for ADUs. Those are a lot of the key points that I read from another article. And so the industry is changing. The whole industry itself, in terms of commissions and compensation and who pays for what, and negotiating the new forms and whatnot, is a challenge to some of the realtors. To some of the rest of us who are still working, I know I'm having success in getting my clients to sign my buyer representation agreement. And I explained it's all about just explaining to them that it's not guaranteed the seller pays a commission. Therefore, it may have a small chance where you maybe need to be responsible to purchase or pay for my compensation in the event we get accepted to a home that does not want to offer or pay it. But at the same time, I'm going to still negotiate and request for it or do everything I can to avoid you paying for it. But at certain times, this is what the industry wants for us to have an agreement, a service contract agreement between us to ensure that I'm not working for free. And obviously, anything that I earn or anything that I do, everything will be transparent. So some opportunities are going to be opening up as we see. New policy can and help us significantly in terms of various legislative bills that are upcoming. Potentially, there could be some bills regarding allowing some of the red tape in the government to pull permits to potentially help a little bit more in um, making it easier for builders and developers to and more cost effective instead of having to pay all the high fees with the city. Consumers really do need our industry, and there are some counter-cyclical things going on in California that are very niche oriented in specific markets. So there are some reasons to be optimistic. They do feel that rates right now, these are your average 30-year mortgage rates. You can see 2021, we had the all-time greatest mortgage rates offered for a whole 2-year period. Borrowers can get around under 3% during this year and a half period. So what we're seeing now, everyone's going, oh no, we're at 6% rates. And they're kind of, you know, historically upset. But if you look at the last 50 years of where this data is tracking, we're actually way below majority of those decades. This point right here, where we're just under and hovering around 6%, is actually just only the last 10 years it's been very favorable. And every other year before that has been above 6%. So this kind of just puts some perspective, a big wider perspective into those who feel 6% is just crazy. It's not crazy. It's about norm. And I expect it to be around here for the time being, at least a good 12 months. It'll be hovering around this time, around this rate. So despite it all, sales have not returned to the winter lows. What we can see here from the number of August sales were kind of down, and it's year over year, it's 19% than the year before in August. So yes, we had a slower summer than usual in terms of sales volume. So that's just something to keep in mind when your clients ask, how's the market? It has relatively been slow for the first 3 quarters of 2024. So the studies that the CAR has kind of put together here is in practice, we do not observe these outcomes. What is it? What kind of outcome? Well, it's under the right condition, renters would come out ahead of owners, is what some people are thinking. But at the same time, I don't think so because renters are not having a tax write-off, a deduction against their income. Renters are helping someone else's mortgage. Renters are delaying their own, they're delaying their own financial freedom, and they're not in control of their monthly rent. Why? Because landlords get to do annual rent increases. It could be up to like 9 or 10% year after year after year. Landlords are always in control, and it's not nice to always be at the mercy of not necessarily knowing how much your rent will be next year or whether this landlord wants to renew your lease or not. So you could be kicked out at any time, and that's something that's hard to swallow, especially if you have a family. So it's still very prudent for us to go out and recommend and spread the word of homeownership to many buyers who are still renting. We just had a class this past week regarding even people who do have jobs. If they're under the threshold of under 100,000, 120, 10,000 gross income for their family, they may qualify for down payment assistance with the Fed. There's a program out there, it's a federal program in which they share appreciation, and it's a forgivable loan if you live there for 15 years. So there's a lot of cool stuff to benefit people who have jobs, but maybe not in sufficient down payment for 20%, for example. Maybe they have 10%. We can still get them into a home. So household income by owners are all still rising. Those who own real estate are up here in the top bracket. Those who rent always stay artificial
Kelvin,
and remain.
Kelvin, we
Yes.
only see your screen is a download PPT,
Okay.
so we
So you're
don't
not
see
seeing
any
any of those
others.
slides. All right. You should let me know earlier. Thank you.
Oh, sorry.
So
Yeah.
now do you see the slides?
Yes, yeah. Right now
Okay.
we saw the
So
slide.
yeah, thank you for sharing. Owners are coming out ahead. And what this is the net worth. Your net worth, if you own real estate, you are showing a gradual moderate increase year after year after year for those households because obviously as their property appreciates, their household net worth also appreciates. And if you never own real estate as a renter, you stay at the bottom line, which is not much net worth. So that's something where we should show that a lot of the families have already started recognizing it's important to own real estate, and families are starting to also show the similar line path of benefits of home ownership and your future net worth. So this is what we want to do in terms of the polls and questions that were asked to consumers. And yes, in every single year, 2018, 19, 20, 20, I don't know why 2020, they didn't do the polls during the pandemic. Each year, 4 out of 5 people say yes, they wish to be a homeowner at some point in the future. Only 1 out of 5 desire not to be a homeowner. And maybe this because they really don't, they want to have freedom. They want to be able to move. They don't like having commitments or financial obligations. Sure, 1 out of 5. So what's the delinquency look like in terms of delinquency rate for mortgages? Right now, in the last quarter of these data here in Q2 of 2023, we don't have a lot of what you could call 90 plus days of delinquency. And you can see here, we're actually at a point where pretty much most of the Americans can afford and they're paying their mortgage payments. Nobody wants to lose their home. Nobody, most of the people already have what's called a reasonable, attractive financing rate. They don't want to lose that uh, payment and rate that they have. So every homeowner who has a mortgage, by all means, this is kind of like an all-time low that these homeowners are paying off their debt and they're being responsible. So what does that mean? We don't have a short sale going on in the near future. We don't have a foreclosure crisis or a housing bubble or a crash because people are paying their mortgages. It's not very much delinquent, but in 2009 and 10, this is the crash that we experienced. This is regarding 10 to 12% of the homeowners were falling behind on the mortgage. Okay, now it's 2 to 3 per 2.5, I don't know, 2.25. It's very low, very, very low delinquency rate. So homeowners are now having an all-time high of their equity. This bars represent the amount of equity in orange. And so the market value of the owner's real estate is really, really surpassed any year past history. We have a great market for the sellers. And as we see, the median home price in California is 859,000. That's exactly what I told you in the beginning. It's a lot. That's a very high median California household. This is including the farmlands. It's including small parcels, everything. This is a very high, uh, and year over year, this is 3% greater than the year past, by the way. So job growth is still very healthy. You can see here, that's the bar, and we're talking about supply and demand. So in terms of wage growth year to year, the average bar used to be about 2% average wage growth. Now we're roughly around 5% average hourly wage growth. So that's kind of setting a higher bar, more income to all families. So that's showing that that's how people are paying off their bills and mortgages, is because there's a little bit higher in incomes. Consumers still propel the economy as a result, and you can kind of see that the real growth and where is their growth happening? It's mostly in retail, um, right here. But don't take your foot off the gas. What does that mean? This is the what's called June 2023. The federal the chairs that sit and make the decision on the target level for a federal funds rate, they on average felt 4.5% would be the mid-range target level for the federal funds target rate. Now in September 2023, the most recent dot plot map shows and reflects 5% is the mid-range. So we're going to expect to be remain here for the foreseeable future. And so now the bond market makes it a little bit higher for longer type of rates. And so this is going to show you what's going on in the bond market and what it costs to borrow money from the bank side of things. What it all really falls down to is that the 30-year fixed mortgage, right now it's floating at 7.19%. It did peak back up just this past week, but we do expect it to hold this level or lower quarter basis points, maybe every other month to the federal fund rate. So that's what your what's called 30-year fixed mortgage looks like. It still remains elevated this year, but next year will be very good. Affordability and purchasing power is near all-time lows. It's not very affordable to buy when you have high prices and high payments and high interest rates and cost of inflation and all the goods and services. Everything is just kind of high. It's just, it's just stressful being here in California if you're a resident. So buyer demand reflects the impact of higher rates. This is the amount of demand there is, buyers. And you can see here, it's buyers' demand is kind of low. But in the peak of 2020, 21, when people were going crazy and there's lining up out the doors just to see homes and write offers, buyer demand was very strong. Right now, it's still very low. These are the number of new mortgage applications. We're tracking a lot of data to help you understand what's going on behind the scenes in the mortgage department, in the housing, in terms of prices, the Fed, legislation, as well as, just the data that we could see from the MLS. So California CAR says that there's a lot of remote work going on, and that's causing a lot of migration. Migration is meaning moving away from high density, popular population wise areas like downtown LA or Santa Monica. So a lot of population and workplaces in the downtown regions where offices are cutting down. Companies are allowing, for example, half days are remote, half days you come to the office. And a lot of companies are still having a very flexible options to keep their existing salaried employees from jumping to another company. They're offering them to allow them to work remotely at home. Therefore, people are moving to lower cost households. Maybe they're moving to somewhere where they can get a bigger, more bang for your buck, larger homes when you move more east as opposed to downtown or in the west side. Correct? So that is a very sharp decline in uh, exodus of population migrating outside the major metropolitan areas like San Francisco. So here's the vacancy rate of San Francisco office space. 1 out of 4 offices are vacant. And you can see here, this is regarding the absorption rate. I'm not going to cover that. That's more complex. But as the inflation shows that it's tough, we can see here in these slides that the percent change in the consumer price index is now healthy at 3.7%. And the core CPI is kind of showing down. So finally, we show some signals of inflation being in check under 5%. So that's something good. Finally, we're starting to slow down and not have such exorbitant rates. The gas prices at the pump right now are very reasonable, under a little under $5 a gallon. And we're starting to have some more what's called just corrections going on. So where do we find ourselves today? Well, the yield curve remains inverted due to short run worries. Right now, what they're explaining is that when we have a yield curve inversion, that is telling us that it's an indicator that every time you see in the red, historically, there's a recession in the gray marks for a good year or two. Red over here, recession for another year. Red over here in 2007, 2008 and 9 had a 2-year recession. And so now we have a deep red inversion of the yield curve. So that is the one question mark that does not rule out that a recession is on its way. So because of this short run worries of the yield curve kind of just being too expensive for borrowing money, there was too much stimulus and too much postponement or delayment of payments and company kind of borrowing. It's really allowed a lot of things to go out of check. So we're running out of gas, is what it says. Credit card debt delinquencies are starting to rise recently. Last year, it used to be around 1.55%. I'm sorry, 2 years ago, 1.5, low delinquency rate. And look at the blue bars. This is the amount of debt rising and rising every quarter between consumers. So that is definitely showing to us that those who are borrowing and paying for stuff out of credit cards and just making the minimum payments, they're gonna be digging a shovel and keep digging themselves underwater by not paying off their credit card bills. Inventory does remain the biggest challenge for California. If we had a lot more inventory, prices would be a lot more reasonable and affordable, but it's tight. There's not a lot of land left to build density and homes. So you're seeing most of the new construction builds to be either master planned communities or PUDs, or they are condos and townhomes. Those are the products that most buyers and builders are finding to still be somewhat profitable and still offer a great product and have a nice place to call for consumers to live. So this is showing us the inventory is still near all-time lows. And so this inventory is causing prices to remain elevated. As we look at the mortgages by interest rate, most people are right here in the bucket of uh, under a third of the people have a mortgage rate less than 3%. Another third is 3 to 4%. So altogether, two-thirds of Americans, actually 68%, yeah, two-thirds of Americans, Californians, are under 4%. So it's only these people here that are at risk of losing their mortgage if they was a big crash. These people here who have high rates at 6% plus might be the only candidates who want to lose their mortgage and maybe go under a short sale foreclosure. Not many people. And as we see that by county, we can see the number of households being reported and number of sales. But at the same time, here's who the homeowners are. If you're looking to be a listing agent, you should 100% be checking the largest pie, and that's people 65 plus and older. These are the greatest and most volume of people, leads, and transactions that will happen in the near future. Almost a half of the people out there are 65 plus. So if you add in the 655 to 64 aged individuals, that will represent almost three-fourths of the pie. So those are the people who have property, start networking with them, hopefully get some sales and then convince them of the benefits of selling now at a peak. Okay. So these are the by Los Angeles County. Let's take a look right here. 45% of the Los Angeles County is a homeowner owner occupy. That means everyone else, 55%, are renters or they're living in their car or homeless or unreported data type of people. Okay. So 45% is considerably quite low home ownership rate as opposed to home ownership rate. Yeah. So in terms of reaching a record high, these are the number of years before a person on average will sell their house. 12 years. Okay. So if you buy a property today, most people will stay in that home for another, on average, another 12 years. It's very disincentivized for any homeowner to just keep moving every 3 or 4 years because it's just so much burden on moving and cost to, and also just higher property tax and all that stuff regarding qualifying for a new mortgage. So in terms of permit activity, like I told you, we're only pulling permits of roughly 130,000 as of 2022. So by the year or year and a half when this product is done, there's not a lot of homes being built because the housing community and development department says we need on average 180,000 permits to be built every year just to keep up with our population of California. And that's telling you very something that, yes, it's been 40 years and our population is increasing significantly. And here's the number of jobs we have, 18 million. So we need to have a higher threshold of permits, but insurance is becoming a really big issue for home buying for many borrowers. If you're buying in rural areas, and vacation second home areas like Big Bear or Santa Barbara or Lake Tahoe, guess what? These areas have high fire risk areas, and therefore home insurance is hard to find. So when we talk into the MLS lawsuits and industry regarding NAR settlement, there is some things that have changed and disrupted, and there will be new technologies. There'll be new ways you present information. There's AI, but at the same time, in our practice, where is the opportunity? Well, the opportunity lies with the consumer. Now that they're educated, they're all understanding that um, the importance of home ownership and whatnot. There's some opportunities where they should already be self-convinced they want to buy their own home. So most people think that they have to purchase a home with roughly 33% down. And that's not true. We can get a lot of people in under 10% or 20% financing. It is very most buyers are what's called misinformed and not aware that they can get down payment assistance, that they can qualify for programs. So what is showing to us on average, it's about taking 18 days to sell the average home. And most of the properties, about 47% have sell above asking, and about 1/3 have to do a price reduction. So what we're seeing is most people who sell are 1 out of 3 are going to the same county, but 1 out of 3 also are opting to move out of California. So that's a big number of exodus of Californians leaving this high expensive state. So being a buyer's agent, it is tough. I understand how hard it is to not particularly have a secured commission or having to negotiate stuff, explain things. But it is worth the effort because the number of first-time home buyers out there, roughly a third of them, do still need an agent. So you should still want um most of these buyers do want representation. Okay. The share of vacation home buying is roughly 8% of the sales in the market right now. So there are still a lot of vacation areas and secondary homes being sold. And in terms of rental property sales, it's only representing about 11% of the properties sold are investor owned. All cash buyers are still in the market. As the rates rise, they're still there, except these people who are all cash buyers are still feeling that they're king. And so almost 28% of all sales, of all cash sales, are done in 2023. That's quite a bit. Okay. That's almost 1 out of every 3 or 4. So you can see here the international buyers, slight uptick in international people moving here to California. And when we look at the total pie of the households and income, this is just some data for you to share with you. I won't spend time on that one. As you can see, ADUs is the largest structure that's being built right now in California. This is the most amount of permits being pulled. And if you take all of this information into account, here's what the forecast looks like for the US. We are anticipating, and this is called 2023 present day. We are looking at a 1.7 GDP, and for next year, and I'm sorry, it was predicted in 2023 that 1.7% US GDP was what was predicted. It turns out that up to year to date in 2024, we're only at a GDP of 0.7. We have much lower job growth that are non-farms. So it's very flat in
張
job.
生，你而家快啲瞓一陣，你今晚都係要同我去乜嘢啊？
And we have unemployment rate at 4.4%, still very healthy and lower than 5. It's nice. The CPI index, the core CPI inflation is right around 2.6%. That's healthy because it was predicted to be 3.9% last year. So finally, we have some signs of cooling down inflation, and the real disposable income, it represents about 2.1% of your income is disposable. So the economic outlook, well, this is kind of just uh, not really related. Let me just talk about the housing market pricing. So the single family home sales, the resale, well, let's take a look at what this says. Roughly, they predicted a minus 22%, 22% less number of sales. And so that's kind of turning out the median home price is about $860,000. It shows a big jump increase from the prediction. And that's a 6.2% change year over year. So that's some things to keep in mind as we look at the housing market. It gives us a nice little script of a story that we could share with our clients, hopefully use that story to persuade them to sell or to buy and take whatever information. You're the what's called the deliverer of the news. So the more news that you watch, the more articles you read, the more news you can hopefully share. And what's the big news nowadays? What's going on in terms of legislative bills? Um, we can pull that stuff up on the car website. But let me ask and stop right now first. Is there any questions?
Yeah, Kelvin, at the beginning, your slide is stop. Is it they have a down payment slide you can show us?
Sure.
Thank you.
So it's probably one of the first slides. Let me go back. So this is page one and down payment. Mm,
No, no, I think it's the previous one, not this one. The previous.
here,
Okay.
these were what's called, this is a strengths, weaknesses, opportunities, and the threats, the challenges.
What about the percentage down payment? Is it they have a slide for that too?
No, not
No.
not at the very
Okay. Oh, yeah,
beginning.
that one. No, 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 no. No, previous one. Yeah, this one.
This is the average 30-year fixed rate mortgage. This is
Yeah,
what I was telling everyone that we're right here at this 30-year fixed mortgage around 6%,
yeah.
which is
Okay.
it's been this way for the past year.
Yeah, we
And
need that. Thank you.
only the last 12 years have we been under 6%.
Yep.
All the
Uh-huh.
other periods, and historically speaking, has been greater than 6%. 2009 and earlier, we were at much higher rates. So it's only this small, and this window over here, the last 2, 3 years of 2021, were very, very artificially low rates because the Fed said, "Hey, we got to help our COVID economy," and they did that. They kept rates low on purpose to avoid people from losing their homes. So that's good question. Any other questions? Well, then let's take a look at we still have maybe another 10 more minutes to cover stuff. No one has any questions on anything. I do want to point out really good, learning could be conducted here. And I just type in what's called legal live webinars. I like these little podcasts they have here. So you can go to what's called the webinars and upcoming and not. And the attorneys are sharing some cool stuff. So you have what's called webinars that you could attend, like realtor resiliency, how to do zip forms. But there are also the legal live webinars, which I
Good
wanted
morning.
I wanted to point to, but you have to be signed in. Dealing with abusive clients and agents. How many of you guys have been abused? I have. My client just tried to renegotiate my commission and wanted half a percent, wanted half of whatever I earned as a rebate. And I said no. And they tried to step on me and make me belittle me and my worth. So I turned down that business. And so, you know, there are going to be people like that. So if you have any interest in the new laws for 2025, there's a class next month. If you're interested in landlord tenant issues in sales of estates, go ahead and watch this one. And there is some what's called recordings of the past ones. So the abusive clients and was already recorded here. You can download the slides that they gave out in the class if you happen to missed it. So if you want to know more about communicating, collaborating, and commissions, this is a great class for you to help you negotiate better and explain to your clients your value proposition. After this, let's take a look at CRMLS. So I'll spend 10 minutes and go over some market stuff that we're seeing locally. And as I pull in my CRMLS, well, I mean, I do follow my own North San Gabriel Valley region. So let's take a look. We do have 16 new listings on the market that are, I'm sorry, not new. These are 6 brand new listings, and this is all single families, not condos and townhouse. But what I am doing is seeing a spread a cross section. Well, look, there is a good 6 homes that went from hold to active. Okay, something's going on where these properties were being held off the market for a while. You do see 10,000 price cut, a 30,000 price cut, and another $35,000 price cut, 37,000. So nothing is increasing, only showing signs of weaknesses. So as we see several things when I clue in on properties, when I do a market update, I also see what's going on in my own marketplace. And when I look at stuff like this, let me click the next hot sheet I'll show you. It'll be a wider, um, it'll be a wider net here. Let me see. I'll just show you like here, residential detail, actives, and close. And I just draw a polygon around Temple City. Let's see what's going on in our region here. I'll start around Alhambra to Monterey Park, El Monte, and I'll include a little bit of Monrovia and Pasadena. All right, so this is our actives and closed that I'm using as what's for sale. Okay, let's just take a look at the single families, condos, and townhouses. And let's go ahead and take a look at how can I filter some of these matches out. Let's just keep it a single family only. So pulling this data up, 5,000 stuff to look at. This is not correct. My map didn't save then. So now that I put my map together, it shouldn't be 5,000. Now it should be only this 626 region here. And I can sort by actives and solds. Let's first search at the solds. What's one thing I can do? Well, first thing I can do when I look at some of these properties, all of these first thousands or two, let's see what this arrow looks like. This arrow represents that it's sold less than the original asking price. So the market is telling me all of these properties, this is kind of like 95% sold under asking. Yes or no in 626? Yes, it is. So that's one clear signal that the buyers have a little bit of strength and borrow and positioning power, leverage, call it whatever you want. Buyers are getting it under the asking price. Okay, that's just one thing I can read into this market. I go into I can do this specifically by city as well, but obviously I'm just doing a little demonstration for you what I can do with the data. Then I look at, well, let's take a look at how long on average are these properties taking to sell? Okay. There's quite a few of these in this region have sold right on the day of the market. And that's probably just what's called a realtor just inputted it right away and probably sold it off market already. But some of these properties are taking 3, 4 years, 2 years to sell. Okay. So when I look at days on market here, and you look at a big section of the real estate, you have people have listings greater than 180 days. They took a year listing, or they have a $60 million property on Lombardy Road in Pasadena, and it's way overpriced. Okay. So obviously you got to just do your analysis on your own, but none of these show to me what's called a solid, strong seller's market. It's showing to me that there's softness in the current pricing. Okay. And obviously the smaller your data, the easier it is to read all this information. But when you see a lot of days on market climbing, that is something that's alarming and slash has a lot of room for negotiation or is tenant occupied. I'm going to show you one other exercise that I do. Let's say I'm looking for a hot deal. I'm looking for some properties under $1 million. Okay. And I'm a flipper or an investor, right? I want to buy something under market, under $1 million. What would I do? I must be a single family. I don't want any closed properties. I only want actives now. So now I've left with 209 properties. If I'm shopping for someone who says, hey, Kelvin, I want to buy a good deal. Can you find me a good deal? I want to flip a property. I want to remodel it. And I want to work on a project. I have some cash. So what do I do? What I'm going to do is obviously do a few different things, but here's one of my first steps. I've narrowed down my criteria like I showed you. I'll start searching the longest days on market, and I'll be skimming for the ones that are obviously vacant, and I would send them the ones that are sitting around. Next thing I would do is I'll probably look for a lot size that's workable. So one thing, what's workable, depending on your county, you want a 6,000 plus lot size because of the purposes of a junior ADU at minimum, or maybe an ADU if you have 6,500. So this will narrow down my results. Awesome. Now I have narrowed that 200 down to 93. Here's another strategy. I can sort by value, by price per square foot. So this property right here in Los Angeles is the lowest price per square foot of 316. And some of these are here at the 400 range per square foot. And I can just start going, all right, look at this one in near Lincoln Heights. Okay, I don't see inside. It's probably with existing tenants. And so therefore, I'm not interested. I want something vacant. So if you have something that you don't want tenant occupied, go back to your criteria. It's hard to work on a property when someone's living in there. So you can go into what's called occupancy type. So let me show you a strategy that'll help you search for your investors. I need to look for occupancy. And when you don't see things here right in front of you in what's called the most common search fields, there's a way to add it. So I was searching for it. I didn't see occupancy type. So therefore, I need to go to what's called add remove. And if I'm interested in occupancy, I type it. Right here, occupant type. I add that in, go back to my search results. Now I have a whole field where I can search occupant type. And if it says tenant, I will say don't want any tenant occupied property. So that'll help me filter my results for my investor so I don't waste his time. I don't waste my time by saving this 30 seconds that I showed you how to do this. So if I'm avoiding tenant occupied properties, now I can narrow this down from a lot more. It'll just narrow down my search time. So this is a fixer-upper right here. Only 366 a square foot in El Monte. And you can see here it's damaged. It's got a lot of work to do. It's torn apart. And it looks like someone had a bad day. Okay. So this is red tagged property, as you said, Grace. So that's why this value is very large structure of 1867, but it's a cash only investment because this does not qualify for conventional financing, obviously. Cool. My cash buyer can get this one. It's got a 7,300 lot. You could build an ADU and get this done. There's another one here in Los Angeles. This is also a fixer-upper. Um, it's just got an older style, but it's empty. And if it hasn't sold for 539 in 5 days, it probably will sell quickly. Okay. So submit when you see the words highest and best by a deadline, that probably means the listing agent is communicating to you that there's going to be multiple offers. So don't send a weak offers. Try your best. Maxon Road, another one in El Monte. This is a price reduction of 50,000, and you get a large 2,500 square feet with a 10,000 lot. Not too shabby. So I easily just found a couple of what's called values simply by just sorting by price per square foot. And these are, priced attractively, yet there still is room to negotiate further for those that are sitting on the market more than 2, 3 weeks. That's more leverage to you. Okay. So I'm going to show you one last trick before we end today. Because if you stayed here, you're listening, you want to know a few Kelvin's shortcuts. All right. So if I was also still looking for the word investor, I can go ahead and show you another little strategy I use, which is public remarks. Star, TLC, star. these three properties, the listing agent said it needs TLC. Okay. So there's this one on Magnolia. And obviously with some TLC, you can add value. You can buy this single family house for $550,000. Hey, it's got a 7,000 lot for 550. Yes, you can still get a house, single family. But this is a little bit more than TLC. Okay, you drive by, you'll know what I'm talking about. Um, but here's another one that mentions TLC. La Rosa Drive. They just reduced price. With a little TLC, you can, and where do they, I want to show you and prove to you where they wrote it. Right here, TLC Fixer. Okay. This helps me identify fixers. And if you want to search, I do it again. I only use the one word TLC. Now I want to use star fixer star. And now let's see which ones are fixers described by the agent. This one is Dozier Street in LA as a fixer. Yep, it needs some fixing. And you have Onyx Drive is a fixer. Okay, yep, needs some work. So this is just an easy way to do shortcuts. If you know what the choices that you're looking for, you can use it for anything, like a pool. Most agents will write a pool, so they'll go ahead and describe it in their description if that's something you're looking for. But it doesn't have to be limited to simply just fixers or pool or TLC. You can write the word like investors. Okay. Investors without the D. So the agents are targeting investors. They'll write it in here. Great. You'll see these 6 here, target investors. If you want to use the word something like, maybe you want to have, and this is only one strategy. You can also search private remarks too. Okay. But at the same time, I'm just here to kind of give you some shortcuts that's helpful. And you go ahead and do what you want with saving yourself time. Okay. Any
Thank
questions?
you.
All right. Any?
Kelvin, I have some question.
Yep.
Yeah, before I received a lot of like text or email regarding some people I want to search buy or invest the property. Do you think all the scammer?
It could be because
How to verify it? Because sometimes because I don't know them or usually I just buy off.
so you it's hard to verify. There is something you can do. One is who is, there's a site, who is lookup. And so you could look up, I'm sorry, not who is. Let me see here. I got one today myself. So I already put it in my spam, so let me search for it.
So some is I will ask them, if you want to buy the house, will you please just send me the down pay improvement POF. They send it, but I don't really think they're real.
Well, yeah,
They
so
send me
okay, here, let me show you one example. This is not the only way, but one of the tools I use is Fast People Search. And then I look if it's what's called a registered number or owner or real person. So
okay.
if you give me someone's number, I can put it in.
Right now, I
Yeah.
buy off. Usually I buy off, so I don't keep it.
Okay. Hold on. Grace is gonna share one, but because there's information, I have to stop the recording first, and then I'll show you.
Okay.
So this ends today's class, and I'm gonna show you after I stop the recording. All right. See you guys next week.